The gentleman is recognized.
Mr. Speaker, I rise in strong support of H.R. 4015, the Corporate Governance Reform and Transparency Act of 2017. And I thank the sponsor of this legislation, my good friend Mr. Duffy of Wisconsin, the chairman of the Housing and Insurance Subcommittee of our committee, for offering this bill. Each year, Mr. Speaker, public companies hold shareholder meetings where shareholders vote for the company's directors and on other significant corporate actions that require shareholder approval. Mr. Speaker, the House is not in order.
The gentleman is correct. Ladies and gentlemen, the House is to be in order. Take your conversations off the floor. The gentleman is recognized.
Mr. Speaker, the Securities and Exchange Commission requires that before these annual shareholder meetings take place, public companies must provide shareholders with proxy statements that include all important facts about matters to be voted on at a shareholder meeting. Many shareholders and investment advisors rely on information provided by proxy advisory firms to guide their votes on these matters. H.R. 4015 would enhance transparency in the shareholder proxy system by requiring proxy advisory firms to register with the SEC, disclose potential conflicts of interest and codes of ethics, and make their methodologies public. Mr. Speaker, this is a pure disclosure bill, nothing more, nothing less. Proxy firms play an outsized role in the U.S. economy in shaping corporate governance. They counsel pension plans, mutual funds, and other institutional investors about how to vote the shares of corporations that they own. With respect to institutional investors, Mr. Speaker, the share of institutional investor ownership was roughly 46% as recently as 1987, but today that figure is more than 75%. In other words, the volume of proxy votes for which investors are responsible has grown into the billions. In 2003, the SEC adopted a rule under the Investment Advisors Act that requires an investment advisor to vote in the best interest of their clients on proxies. A series of SEC no-action letters give the investment advisor a fundamental safe harbor from liability if they use a proxy advisor. As a result, institutional investors have increasingly relied on proxy advisory firms to help them decide how to vote their shares. However, regulators, market participants, and academic observers have highlighted potential conflicts of interest that are inherent in the business models and activities of proxy advisory firms. The committee, for example, is aware of numerous instances whereby the two largest proxy advisory firms have issued vote recommendations to shareholders that include errors, misstatements of facts, and incomplete analysis. For example, in one instance, a company reported that even though the total shareholder return the company actually had generated for its shareholders was 64%, the proxy advisory firm Glass Lewis erroneously reported this calculation to be 26%. Another company reported that ISS erroneously reported that the company's long-term cash awards will vest and pay out their maximum opportunity in the event of a change of control. Well, this was reported even though the company's plan had been amended and approved by the shareholders years earlier in a manner that would pay out at target upon change in control, and there are many other examples. Some proxy advisory firms' recommendations have been made without any contact to the public company at all, and then these same proxy advisory firms encourage companies to join their service in order to have the privilege to, quote, influence an advisory firm's recommendations. I suspect for many people this simply does not pass the smell test. An industrial company told its shareholders, Mr. Speaker, quote, ISS's negative recommendation was based on flawed analysis of our compensation programs that did not appropriately take into account the significant declines in our CEO's pay in 2015 or the performance-based nature of our annual and long-term incentive compensation programs. A pharmaceutical company responded to a proxy advisory firm's recommendations with this statement, quote, for the second year in a row, Glass Lewis did not include its full pay for performance analysis in this report. For shareholders who rely only on Glass Lewis materials to make voting decisions. There is no discussion of the company's industry-leading performance over this time period. Again, Mr. Speaker, there are many, many more examples like these. So another concern that many people have, Mr. Speaker, is that the two largest proxy advisory firms collectively make up 97% of the proxy advisory industry, 97%. This monopolization in the regarding proxy advisory firms means that the writings, analysis, reports, and voting recommendations of these two firms have a disproportionate effect on fundamental corporate transactions like mergers or acquisitions, the approval of corporate directors, and shareholder proposals. In other words, these two firms have a huge impact on our economy. The gentleman from Wisconsin, Mr. Duffy's bill, helps address these concerns by setting up a new regulatory regime for proxy advisory firms that looks out for the interest of investors, shareholders, by ensuring they receive complete information through the proxy process and can better vote in a manner consistent with shareholder interest, as opposed to the potential conflicted interest of a proxy firm. Mr. Duffy's bill also helps ensure that shareholders and their proxies have access to accurate information regarding companies by allowing companies to provide input on proxy recommendations. This is especially important for emerging growth companies that rely heavily on investors. A bad proxy recommendation in which emerging growth companies cannot refute the recommendation can be devastating to those emerging growth companies and thus have a harmful impact on our economy. In a letter to our committee, the Biotechnology Innovation Organization wrote, quote, "Small business innovators operate in a unique industry that values a strong relationship with investors, yet they are often held to standards that are not applicable to their company and forced to engage in proxy fights over issues that do not add value to shareholders." H.R. 4015 would provide for SEC oversight of proxy advisory firms, ensuring that they operate within appropriate boundaries and can be held accountable to regulators and the public, unquote. To be clear, Mr. Speaker, nothing in this bill permits companies to rewrite a proxy firm's report or force a proxy firm to change its recommendation based on feedback received from the company. In summary, H.R. 4015 will improve transparency in the proxy system and enhance shareholder access to information by ensuring that proxy advisory firms are registered with the SEC, disclose potential conflicts of interest and codes of ethics, and make publicly available their methodologies for forming proxy recommendations and analysis. For every member who believes in investor protection and supports a healthier economy, they should support H.R. 4015. I reserve the balance of my time.